Hey everyone, it's Dave with Dave's Market Explorer. Thanks for tuning in. Today we're talking about a key question in the markets right now: higher than correction? That's what Tom Lee is calling for, and it fits with our time and timing model for June-August as a primary time target and Sept-October as a secondary target. As a reminder, when price is going up into a target, that means usually there is some kind of reaction or at a minimum a consolidation biased in the other direction. So up into the primary target would suggest down into the secondary. As of Tuesday, July 7, 2026, Tom Lee just reinforced this exact setup in his latest comments. He's calling for strength in July, with the S&P 500 potentially pushing towards 7,700 to 8,000 near term and up to 8,800 by year end on strong earnings and expanding multiples. But he also warns of a 10 to 20% drawdown that could feel like a bear market between August and October before the next rally. This lines up spot on with our timing windows. Let me expand on that. Tom Lee highlights improving earnings, a more reasonable valuation backdrop after Q2 results, and investors who are still offsides and ready to buy dips. At the same time, he flags risks around Fed transitions and seasonal factors that could trigger that pullback. Our MTF-SRG system and Fibonacci-based time projections have been pointing to the same pattern: momentum building into the June-August primary zone, setting the stage for a counter move or consolidation as we hit the September to October secondary target. When price is going up into a target like this, the probability shifts towards some kind of reaction. It doesn't have to be a crash, but at minimum we watch for exhaustion signals, negative divergences, or simply a pause that lets the market digest gains. This is classic behavior in our models, and Tom Lee's outlook adds strong fundamental confirmation. For your trading plan, this means staying engaged with the upside through the summer while tightening risk management. Use any strength to trail stops or take partial profits. Then, as we approach the secondary target, that potential correction becomes a high probability area to look for entries on the long side, especially if broader macro support like liquidity and earnings holds. Bitcoin, tech, and other risk assets often follow similar paths, so cross-check those charts too. Bottom line, the bigger picture stays bullish according to both Tom Lee and our timing work. We get the higher move first, then the healthy correction that creates the next buying opportunity. Markets climb walls of worry, and this setup gives us a clear roadmap. This isn't financial advice, just analysis to help you think through the possibilities. What do you think? Does this higher than correction scenario match what you're seeing in the charts? Drop your thoughts in the comments. If you found this helpful, like, subscribe, and turn on notifications so you don't miss future updates. Thanks for watching, keep exploring the markets, and I'll catch you in the next video.